Coming up on today's episode, the amount of new jobs created in June comes in less than expected. Chicago Fed president sees a golden path out of inflation. Another warning from another billionaire. China continues to load up on gold. Mercedes-Benz jumps on the Tesla supercharging network. The 50-cent trader is back in the VIX market. Stock indices appear to be stalling out. And Lizard Boy's new app Threads gets 70 million signups. Hey, what's up guys? It's Jared from Click Capital. I hope you're having a great Friday, Saturday or Sunday, wherever you are in the world. Thanks very much for tuning in with me today. I'm going to take you through all the most important events, news and data from the markets today and summarize the week for you. So make sure you hit that subscribe button if you haven't already, as I make these videos every day for you. And so it was a bit of a soft day to finish out the week here. We did see weakness in the defensive sectors like healthcare, consumer defensive, and utilities. Energy had a good day with the price of crude popping up a bit, and mega cap tech finished a little soft. And since it's the end of the week, here's a look at the heat map for the week performance. The standouts being NVDA, Meta, and Tesla, and overall's pretty flat with healthcare coming off and mixed in other sectors like industrials and financials. The big data point out today was non-farm payrolls, which shows how many new jobs the US economy had created. Analysts were expecting 240,000 new jobs. We came in a bit lower than that, 209,000 for the month of June, and the unemployment rate came in as expected at 3.6%. And here's a quick chart of where those new jobs came from. So the leader was healthcare, social assistance, and government, along with construction, leisure, and hospitality, which is to be expected in the summer. And as we go into the cooler months, those jobs could be lost, and we did actually see retail trade actually losing 11,000 jobs. We did see average hourly earnings jump a little bit more than expected year over year at 4.4%. And the amount of private jobs created came in quite a bit lower than expected, 149,000 versus 200,000. And here's a look at a 3-year chart of the non-farm payrolls, with the blue line representing what the actual number and the purple being the consensus. And so that latest read of 209,000 was the lowest print we've had in almost 2 years since October 21. And you can see that chart is in a bit of a downtrend. And at a 3.6 unemployment rate, the jobs market should be getting pretty close to peaking out. This is historical lows in unemployment rate. And when you take out government employees and other non-profit organizations and you look at the private payrolls number, that downtrend is even more evident, and we just got the lowest print we've had since early 2021. However, that's not going to stop the Fed talking up their own book, and that's why we've got Chicago Fed president saying he's confident inflation can be tamed without a recession, even with additional interest rate increases likely. However, economists at the Fed see a credit contraction leading to at least a modern recession later this year. And if this guy's right, it would be one of the very few times the Fed has increased rates, and increased them very aggressively, by the way, that didn't result in a recession or something else breaking. It would also be the first time the bond market got it massively wrong with the inverted yield curve as well. So it'd be almost a miracle if we got out of all of this without a recession sometime in the next 6-9 months or thereabouts. However, those that invest for a living and have a great track record at doing so can speak more freely about what they see. And we've got another warning from another billionaire today. Leon Cooperman sounds the alarm on Nvidia stock and warns a recession may hit next year. He said there's enormous hype around Nvidia and other growth stocks, which is dangerous. Predicted the S&P 500 wouldn't reach a new high for several years. And he said the pressure on consumers and the Fed hiking rates could spark a recession next year. He said that he's learned over the years everything ultimately turns bad, and the fall from 200 times earnings is a lot harder than the fall from 8 or 9 times earnings, referring to Nvidia's current valuation. He noted former stock market darlings like Cisco in the late 90s never reclaimed the breathless highs they reached during the dot-com bubble. He said a lot of crazy things are going on in the market nowadays. I've never seen moves on such insignificant news as we're seeing in the market today. Said that he has a good cash position, but he also sees good values around in other spaces. But like Wharton professor Jeremy Siegel says, the momentum and FOMO out there can still drive stocks higher, but it could end abruptly. He said investors are putting more weight on economic data than looming rate hikes, but deteriorating jobs data and other negative shocks could derail the rally. Another news out today, China continues its path to get off the dollar, and they're doing that by adding a lot of gold to their reserves. They added 23 tons of the shiny metal in June. That was the 8th consecutive increase. And they now hold 2,330 tons of gold in its reserves. And this is just another supportive reason for gold to stay propped up near all-time highs. And just as I predicted over a month ago when we had Ford and GM sign agreements to jump on the back of Tesla's supercharging network, allowing their drivers to charge with Tesla, we've seen another one jump on. That's Mercedes-Benz. And that was after Volvo and a few other electric car makers have also jumped onto Tesla's supercharging network, and once again just cementing the leadership position Tesla has in the EV industry. It looks like the mysterious 50-cent trader is back in the VIX market. This was an article from 2018, and this guy's been around in the market for quite some time and shows up every now and then. And some of his bets have been really successful. Whoever it is, we don't know exactly who it is. Could be a hedge fund, could be an offshore trader, could be some guy sitting in his underpants in his mum's basement. No one knows. Basically, this guy loads up on out-of-the-money VIX contracts waiting for a VIX explosion and then gets out. And then back in 2018, they calculated he made about 200 million in the week that we got that Volmageddon that I talked about yesterday. And that's when the VIX was at a really low 10. Everyone was selling volatility. And then within a few weeks, VIX spiked up to 50, blew up a bunch of electronic traded funds that were short vol, a bunch of other funds and traders. And so we got signs yesterday he's back in the market. And here he is here with a print of 83,000 contracts in the regular October expiry for the 45 calls. And of course, he paid 54 cents, near his favorite price for some reason. And just looking at that chart of the VIX, you can see why he's jumped in. We are super low here. And just maybe this is the bottom on the VIX. And this is the level where he has bought those calls, right at 45 here, which we pretty much only got up to back in the COVID meltdown. So for those VIX contracts to go in the money, something really bad would have to happen in the market, something that we haven't even seen or thought about yet maybe. And you remember a little over a month ago when we were just about to hit the debt ceiling, then the politicians in their infinite wisdom came up with the brilliantly named Fiscal Responsibility Act, which I wasn't sure at the time if this was a parody AI generated meme or not. Turns out it was real. And so they said they were going to put a pause on increases in government spending across the board except for defense, which sounds good. And I'm sure most of the public thought, oh yeah, that they're getting on top of things now, so they're going to get a hold of that huge debt that we all have to pay off. Unfortunately, that's just not the case. So a little over a month ago, when they increased the debt ceiling, the US national debt stood at 31.4 trillion. Now a little over a month later, it's increased by almost $1 trillion, with the national debt now at 32.5 trillion. So that number continues to accelerate, and current day politicians continue to sell out future generations for their own immediate term gains. And the biggest copycat in the world is back at it again, with Mark Zuckerberg's rival to Twitter, Threads, coming out on Wednesday night, and they've already got 70 million signups. However, it's easy to hit that number really quickly because they've already got 1 billion plus users or whatever on Instagram that they just push over to Threads. And so a lot of people are now wondering, is Threads really going to replace Twitter? And are advertisers and users going to jump ship to the copycat, which is pretty much an almost exact clone of Twitter, even down to the fonts and icons and colors. And in typical Zuckerberg style, he's invited ex-employees from Twitter over to Threads, no doubt looked at the source code, which Elon has made public in pursuit of transparency. And coincidentally, in this time since Threads has been launched, Twitter's desktop app saw a surge in outages, which is very convenient for Threads as well. And so basically, it's just like Twitter, but with way more censorship, typical Zuck style. And you just need to look in the app's privacy settings to look at all the data they're going to collect on you and sell and share with whoever's going to pay them for that. Governments around the world, who knows who's going to have all this data on you. And you know the old saying how most people don't change, they just evolve from the original self. Well, check out this exchange from Zuckerberg and a friend just after he started the Facebook. And this has been verified as being real and fact-checked by community notes at Twitter. And this is between Zuckerberg here saying, yeah, so if you ever need any info about anyone at Harvard, just ask. I have over 4,000 emails, pictures, addresses, SNS. His friend said, what? How'd you manage that one? Zuckerberg goes on to say, people just submitted it. I don't know why. They just trust me. Dumb. And so this is probably what he still thinks about us all today, as a lot of people have noted that Zuckerberg doesn't like humans in general. And I, for one, won't be going over to Threads. I'll be sticking with the original Twitter. Which, by the way, you can follow me on Twitter at ClickCapital, where I've also just started posting my daily show, just in case I ever get censored on this platform for saying anything too politically incorrect. Okay, enough of the clown show and back into the charts, and it looks like the markets are stalling out a bit here. We had this funny price action today. I'll take you down to a 15-minute chart. So the S&P 500 gapped down to 43.99. We ran up until a bit after lunchtime, then come early afternoon, we kind of did a waterfall dive into the close, and a bit more on the NASDAQ as well, which finished down a little bit, 0.33%. Overall, another pretty flat, low volatility day. We did see the Russell perk up a little bit, and microcaps actually finished up 2%. Not too many big moves to report internationally, just kind of mixed out there as well. And another typical Friday in the VIX market, volatility diving a bit, helping more contracts expire worthless for the dealers. And there's that move VIX spread, getting as elevated as it's ever been. We've only been higher than where we are now in the relationship between bond market volatility and stock market volatility just prior to things got really bad in the GFC in the third quarter 2008. Little bump up in the breadth here, 62% stocks above their 20-day average, and breadth is pretty soft on the amount of stocks making new highs today. Only 37 stocks in the NASDAQ making new highs. Still got growth versus defensive sectors trading well in this tight short-term uptrend. High beta stocks still hanging in there as well. And there's that bump up in the Russell versus the SPY. Still trying to find support around this level. Big jump up in the 10-year, 2-year yield curve today. And remember, it's when the yield curve goes from inverted to uninverted, back into positive territory, that's when the recession is coming close. So that move in the yield curve was caused by the 2-year bonds pulling back a bit today, rejecting a little bit off the 5% level, and the 10-year yield actually breaking out to new year-to-date highs here. We got up to 409 today. And with the 10-year jumping, that brought TLT down to the bottom of this support zone. And going against those higher rates was the dollar index, which dived a little bit today, just down under 102. Still got Bitcoin consolidating around this 30,000 level. Same with commodities consolidating at their big support. There's a look at crude breaking up above its 50 here on a bit of volume. And over to stock sectors today, the clear winner was the cannabis ETF, up 8.3%. And for my regular viewers who watch the channel every day, you know I shared with you back here I got long this ETF as a medium-term tactical position at 548. Speculating the Safe Banking Act has a good chance at passing this time. If not, hopefully Biden comes good on his campaign promise before the election next year and legalizes cannabis. And I continue to see this as an asymmetric bet with more upside than potential downside, so I'm continuing to hold here. And it was good price action today as we finished up really strong on good volume. There's a look at the AI ETF bots on a really strong bearish divergence. Kind of struggling to hold on to its 50-day VWAP. Clean energy had a good day, up 3.4%. Energy stocks perking back up on the back of crude, and travel stocks still strong, with jets actually finding new year-to-date highs, and industrials and transports still on short-term uptrends, and the defensive sectors, healthcare, staples, and utilities all below their 50-day VWAPs. There's a look at our sector trends table indicator, red in the immediate term trend, most sectors underneath their 5-day moving average, and we've got utilities, staples, healthcare, gold miners, and biotech in downtrends on all time frames. And would you believe it, the retail and jets are in uptrends on all their time frames. So quite a bit of bifurcation in the sector trends out there. We've got weakness in the defensives. We've got the traditional ones like the industrials, the retail, transports, and the financials kind of in uptrends. Then we've got those really high growth ones like the semis just kind of pulling back and stalling, and regional banks going sideways. There's a look at BlackRock and JP Morgan continuing to try to hold onto this resistance zone. There's the price of Tesla shares today at 274. Didn't get too excited about that Mercedes-Benz news. NVDA is still calling up here, and we may get a breakout next week in either direction. We may come up and test new highs at 450. All these bearish divergences may play out, and we may get that big break below the 50-day VWAP, which will be the first time in just about all year that it's gone below. And I can imagine there is a lot of longs in here. And if we just draw a market profile since we went above the 50-day VWAP to where we are now, we can see the point of control just below 270. So most longs are sitting pretty with a profit here. The market would be pretty happy. However, if we do fall below these levels and get towards here, most of these positions will start showing a loss. They'll see their profits evaporate, and that's when we can see that acceleration to the downside as that crowd psychology plays out and everyone tries to hit the exit door at the same time. There's a look at Apple still in this really tight parabolic uptrend. Microsoft's a little weaker, and we can see that coiling up as well. Same with Amazon. Google's even more weaker. There's a look at Meta. The market's not getting too excited about Zuckerberg's new copycat app, Threads. And it's just funny seeing him do this time after time again, like with Snapchat, with any other app, TikTok. He'll copy all the features and functions almost down to a T of whatever else is out there working. And like I said, that's been his business model ever since he copied the idea of the Facebook from the Winklevoss twins 20 years ago. However, at the end of the day, if it makes money, the advertisers go there, users go there, then the market will reward him for that copycat behavior. However, I continue to bet on the original, and I'll stick with Tesla and Twitter. Over to the meme space, pretty big moves up there today. We saw Carvana pop up 21%. And ever since they came in with this earnings report, a lot better than expected. The market's actually loved it, and it's been on quite the run since then. And if you just look at that monthly chart, since we got crazy in mid-2021 like a lot of growth stocks did, got up to 376 a share, then we got down to $3 a share, literally a 99% drawdown. However, if you look at their revenue, they don't have a revenue problem because they got $13.6 billion the last 12 months of revenue versus market cap of $5.5 billion. So trading at less than half sales, even at today's price after this run, what they've got is a profitability problem. They're continuing to lose money, so the market might be saying they're going to turn that around, because if they start printing some positive EPSs, then this thing could keep running and running. Active today was the famous jean maker Levi Strauss. Actually beat slightly on their earnings, but did give negative guidance, and the market didn't like that, sold off 7.7%. And look at that run in EV maker Rivian. So they came through with better than expected deliveries. Q2 deliveries were only 12,000 cars. That's versus Tesla's 460,000 deliveries. But once again, that's come off a really low base after it being beaten down really hard, so we might be seeing a bit of short covering here. Let's look at one of the leading stock market this year, Supermicro Computer, coming back up to year-to-date highs near 270. However, on a big bearish divergence, so we'll see whether we can break through that next week. And not too much else to report out there. The bank's still tracking sideways. There's a look at our SP500 oscillator, currently at a 52.6 reading. And you can look for divergences in this indicator as well. So we've tracked sideways here for the last couple of weeks, but it's now pointing downwards, which shows sentiment and other market eternals could be waning here. And we've got those bearish divergences in the market as well. You can see that in NASDAQ on our DSI and hidden divergence. However, we do have a little bit of bullish seasonality coming up for the next couple of weeks. You can see on our seasonality forecast indicator, as July is usually a positive month in the stock market. However, we do have this strong momentum, and it's very hard to time when exactly that will turn. And that's why I continue to remain market neutral with equal amount of longs and shorts. And so that pretty much wraps it up for the week. Next week, we'll be looking at that CPI and inflation data, especially the core inflation rate year over year, expected to come in at 5%. That'll be a big one the markets pay attention to. As for clues as what the Fed's going to do and their likely future direction of rate hikes. And of course, we'll be looking at weekly jobless claims, the PPI, and consumer sentiment survey on Friday, which has been tracking higher as well. So that sums it up for the first week of the second half of the year. I hope you enjoyed this show and found some value in it. Please click that like button and subscribe if you haven't already. You're welcome to comment below this video. I reply to everyone. Thank you to all of those who do and help out the channel. I really do appreciate all you guys. I hope you all have a great weekend, and I'll see you again on Monday afternoon. Cheers.